People frequently claim that the average millionaire diversifies their income over 7 distinct sources. In contrast, most people rely completely on their jobs for income, making them subject to financial insecurity. Examining millionaires' habits indicates a trend of several revenue sources. However, not all income is the same. It differs in terms of activity level, passivity, taxation, and leverage potential. Today, we'll look at the 7 major methods that most millionaires make money. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Earnings are the primary and most common source of income. This includes earnings from jobs, from regular employees to huge bosses such as CEOs. Many CEOs stay workers of their respective organizations. Professionals such as doctors and nurses come under this category. Earned income is gained by exchanging time for money, often known as active income. This category could also include freelancers. Earned income is often the first step towards becoming a millionaire. It is where most people start and can be a strong foundation, especially if it allows them to support for themselves and their families. However, relying solely on this type of income is problematic because it implies exchanging your time for cash, which, like everyone else, is restricted to 24 hours every day. There is a limit on how much can be earned in this area. Furthermore, earned income is subject to hefty tax rates, which can reach up to 40% of earnings depending on income level. While it's a good place to start, it's also important to look into other revenue opportunities. The second source of revenue is profit. This is the income gained by selling goods or services for a higher price than the cost of production or acquisition. It marks the transition from employee to entrepreneur. Starting a business used to require a lot of money to make or buy items. But with the internet, it's much easier to get started without spending as much money. Profit is generated when the selling price of physical or digital items exceeds the production or acquisition costs. This revenue might be active or passive, depending on the business strategy. Manual product production and sales tend to provide active income and may present scaling issues. In contrast, outsourcing manufacturing or focusing on digital products creates opportunities for passive income. Profit revenue can be divided into 2 categories: individual small-scale ventures and highly scalable enterprises. The former entails personal design or manual flipping of products on platforms such as eBay or Facebook Marketplace, providing an easy way to augment revenue. In contrast, scalable profit revenue is generated by starting a business and outsourcing production, freeing up time for strategic responsibilities such as sales and marketing. These 2 categories of profit income are subject to different tax rates. Individuals who participate in small-scale manufacturing or product production are often taxed in the same way as those who make an income. In contrast, forming a business entity may provide several tax benefits, including the ability to use corporate structures for tax efficiency. Interest income makes up the 3rd category of revenue. Interest revenue is earned by earning interest on borrowed funds. It's usually not a smart idea to lend money to friends or acquaintances. Instead, interest income is typically obtained through safer investment routes, such as placing funds in a bank CD, investing in corporate bonds, or purchasing treasury bills. While these strategies provide consistency, they often generate small returns, ranging from 1 to 4% each year. Alternatively, there could be more imaginative but riskier techniques to achieving bigger profits. Interest income is turned passive since it usually requires little active participation from the investor. The 4th option is dividend income. Dividend income is derived from investments in stocks that distribute a portion of their earnings to shareholders. When you buy stock in a firm, you essentially become a shareholder. Dividends are paid out to shareholders on a regular basis, typically quarterly. As a shareholder, you have partial ownership in the firm and are entitled to a share of its profits. The tax rate on dividend income varies according on its classification. Qualified dividends may be taxed at a lower rate. Individuals earning less than $38,600 in ordinary income may pay no tax on dividend income, with the rate rising to a maximum of 20% for those earning more than $425,000. This rate is significantly lower than the tax rate on earned income, which can be up to 40%. Number 5. Rental revenue. Purchasing real estate and leasing it to tenants is a frequent way to generate rental income. This does not, however, apply only to residential homes. It can also encompass commercial properties leased to enterprises or industrial real estate rented to manufacturers. Furthermore, rental income is not limited to real estate. There are other ways to earn rental revenue on a lesser scale. For example, people may rent out equipment for numerous sectors, as well as their vehicles and musical instruments. Essentially, rental income is any money made by renting a property to someone else in exchange for payment. 6. Residual and royalty revenue. This form of income is about getting paid even after you've finished your primary job. It could be from being in a movie that people still watch, authoring a book that sells well, or, more recently, having a YouTube channel that people continue to watch. Royalty income is a type of residual income earned by allowing others to use one's ideas or properties for profit, such as music or literary works. For example, musicians let streaming services and record labels to disseminate and sell their work, collecting royalties every time it is played or sold. Similarly, authors receive royalties when publishing companies print and distribute their books, and they continue to earn as long as sales are sustained. A single property can generate many streams of royalties. Author J.K. Rowling is a noteworthy example, as she earns royalties not only from book sales, but also from film and merchandising adaptations of her work. Even 2 decades after the first Harry Potter novel was published, Rowling continues to get royalties whenever people buy items, rent or stream movies, or buy books, all of which are based on her original work. Number 7. Capital gains. Capital gains income is generated when an asset that has increased in value is sold. While real estate and stocks are the most common examples, many other assets can result in capital gains. For example, if you paid $180,000 for a property and then sold it for $250,000, you would have made a $70,000 profit. Similarly, buying $100 shares of a corporation for $20 per share and selling them for $120 each would result in a capital gain of $100 per share. It is critical to separate capital gains revenue from profit income. The former does not entail purchasing or producing items to resell at a profit. Rather, it entails assets whose market worth has increased over time. While individuals have little control over the growth in value, capital gains are taxed more favorably than most other types of income. Capital gains tax rates normally range between 15% and 20%, with the possibility of being reduced to zero, notably in real estate transactions. In many circumstances, reinvesting capital gains from real estate back into the market can permit tax-free growth, allowing individuals to enhance their net worth without paying taxes, which brings today's video to a close. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?